You're here because you want to really get a handle on swing trading, right? To see past all the noise and, ride those market waves with a bit more confidence.
Yeah,
Think of this deep dive as your personal shortcut, maybe, to understanding what really makes those prices move up and down.
exactly. And today we're diving into a real classic resource, Chan Arp's 1998 book, The Swing Trader's Toolkit. We're going to focus on understanding those swing patterns and, importantly, how to actually use the tools he built for platforms like Supercharts and TradeStation.
Right. And it's worth noting he was actually a certified Omega solution provider, so he knew the software side too. His website, janarps.com, had even more stuff back in the day.
Absolutely.
So our goal today, it's pretty clear. Pull out the key insights from ARPS about what drives these swings, the emotional side, the fear and greed, but also the structure, the geometry of it all.
And the practical tools.
Yeah.
We'll look at how his indicators help you spot and trade these swings.
Ultimately, it's about getting a better feel for the market's rhythm, isn't it? Aiming to, buy the bottom, sell the tops, ideally, while keeping that risk managed. So where should we start unpacking all this?
Well, let's start with the fundamentals. What actually causes these swings? ARPS really breaks it down into two main camps, psychological and geometric factors.
Okay, psychology first.
Yeah. From that perspective, it's all about the classic battle, isn't it? Fear and greed, buyers versus sellers, their expectations about where prices are going next. That creates the tension, the uncertainty you need for trading to even happen.
Right, that constant push and pull, it's supply and demand doing their dance. That's why markets don't just go straight up or straight down. We get those zigzag patterns we all see, thrusts then reactions.
ARPS uses that great analogy, the dog walker. The owner walks steadily forward. That's the main trend, right?
Not the dog.
The dog's all over the place,
Right.
back and forth on the leash, covering way more ground but still heading in the same general direction. That meandering, that's the market noise, the swings within the trend.
And swing trading tries to profit from the dog's path, not just the owner's.
Precisely. In a neutral market, where buyers and sellers are pretty balanced, those up and down swings, they tend to be kind of similar in size and angle, often stuck in a sideways channel.
But then things change. Let's say buying picks up.
Right. That creates upward momentum. Others see it, jump on the bullish bandwagon, as ARPS calls it, and that can fuel a pretty significant move up, an upthrust.
But that initial surge, it can't last forever, can it? People take profits, others get hesitant.
Exactly. Short-term folks lock in gains. Longer-term players might pause. And the traders who were selling into that surge, they might try to push prices back down a bit. That's your pullback, the reaction phase.
And how deep that pullback goes tells us something.
It really does. ARPS points out that in really strong uptrends, the pullback might only retrace, say, 35 to 40% of that prior up move. It shows buyers are eager, jumping in quickly.
Okay.
In weaker trends, you might see deeper pullbacks, maybe 50, 60%. But if it pulls back more than like 65%, that could be a red flag.
A sign the upward move is running out of steam.
Potentially, yeah. It suggests the conviction isn't quite there. Now, after that consolidation, you often get another push upwards, sometimes even stronger the main thrust. The trend becomes more obvious, more people join in.
But again, that peaks eventually.
Right. ARPS suggests this main thrust might cover 100, even 200% of the distance of that initial upthrust. But after that, selling pressure really builds. Early buyers cash out, short sellers might step in thinking it's overvalued,
Stop losses get triggered.
amplifying the move down. But then you get another layer. Bargain hunters might see value, short sellers might cover their positions. This can cause another little push up the final or blow-off phase.
This is where the latecomers pile in, right? FOMO kicks in.
Exactly. And short sellers often have their stops just above that recent high. Experienced traders, ARPS notes, might even push prices just enough to trigger those stops, sell their longs, maybe even go short themselves.
The classic double top often forms here. Sometimes that second peak is just a tiny bit higher.
Precisely. Then, when the buying finally dries up, the market can just roll over, often quite sharply.
It's fascinating how he connects that psychology to the chart's geometry.
It really is. He shows how these emotional battles create visible patterns, especially within channels. You get horizontal channels in balanced markets, but then uptrending and downtrending channels where the angle itself shapes the thrusts and reactions. That sawtooth pattern.
And those channel lines become important for reversals, too.
Absolutely. As a trend starts to turn, say, from up to down, the way the price interacts with those geometric boundaries often naturally forms patterns we recognize: double tops, double bottoms, head and shoulders. It's like the structure itself sets up the signals.
Makes sense.
ARPS also touches on the classic five-swing fear-greed pattern, which many people know from Elliott wave theory.
Right, the idea of waves within waves.
Yeah, basically an initial move up, a correction, a bigger move up, another smaller correction, then a final surge. It's just another framework for understanding that typical market progression.
So this all brings us to a practical point. How do we actually see and define these swings on a chart using his tools?
Good question. That leads us to creating a visual framework. ARPS talks about two main ways to define how significant a swing is. First is swing bar strength.
Okay, what's that?
Think about a pivot high, a peak. Its strength is defined by how many bars on either side have lower highs. The more bars, the stronger the pivot.
So a really sharp peak sticking way above its neighbors is stronger.
Kind of, yeah. His TT swing high-low points indicator automates this. Red dots for highs, green for lows. And you control the strength input. Higher strength means it only marks the really major turning points, filtering out the smaller wiggles.
And that strength setting is used elsewhere, too.
Yes, that's key. Other tools in his toolkit use the same input, so you get consistency across your analysis. Things like his divergence and trendline tools.
Okay, what's the second way to define swings?
It's based on the amount of price reversal. Instead of bar structure, this looks for a minimum price change either in ticks or percentage in the opposite direction before it calls it a new swing leg.
So it's purely about price movement.
Right. This could be really useful for identifying those Elliott-style waves or other patterns where you need to connect specific highs and lows that meet a certain reversal threshold.
Which leads us neatly to the TT zigzag indicator, doesn't it?
It absolutely does. This is a foundational tool for ARPS. It automatically draws lines connecting alternating swing highs and lows, but only if the move between them exceeds a percentage change, PCTCHG, or a pick change, TKCHG that you define.
And you only use one of those percent or ticks, not both.
Correct. One has to be 0. He gives examples like ticks for T-bonds are 132nd, S&P is 0.10 points. For percentages, maybe 0.1 to 0.5% on a 1-minute S&P chart, but maybe 1 to 10% on a daily chart. You adjust it for the time frame and volatility.
What's the yellow line feature?
Well, that's really handy. The most recent swing leg, the one that hasn't been confirmed yet by a reversal, it plots in yellow. So you can see potential turns developing in real time.
So mastering the zigzag is pretty crucial for using the rest of the toolkit.
ARPS really emphasizes that. It provides the basic swing definition that many other indicators build upon. Get your zigzag settings right for your market and time frame, and the other tools become much more effective.
Okay, so we've got a way to define swings visually. Now, what about recognizing specific patterns within those swings?
Right. ARPS highlights a few specific pattern recognition tools. First up is the TT three-wave swing pattern. This one uses 5 consecutive pivot points identified by that zigzag indicator.
And why is this pattern important?
Well, ARPS observed it has a pretty high correlation with potential trend changes.
Okay, so what does it look like?
For a potential bullish reversal, you need pivot 5 higher than pivot 3, which is higher than pivot 1. And pivot 4 needs to be higher than pivot 2. Basically, a series of higher highs and higher lows forming. The opposite logic applies for a bearish reversal pattern.
And the indicator just flags this.
Yeah, it plots color dots. Green usually means a potential sell setup, bearish pattern completed, and red means a potential buy setup, bullish pattern completed. And again, its sensitivity depends on those TCCG settings you use for the zigzag.
Makes sense. What's next? The Fox wave. Sounds intriguing.
It does, doesn't it? The TT-ARPS Fox wave pattern is a bit more complex. It involves 6 pivots, P1 through P6. The key is the alignment of the first 4 pivots.
How so?
If P1, P2, P3, and P4 line up in a specific way, ARPS details the exact criteria regarding their relative highs, lows, and horizontal spacing. The indicator automatically draws 2 lines, an entry line connecting P1 and P3, and a target line connecting P1 and P4.
Okay, so that's the setup. Where's the trade?
The potential entry signal comes after P4 is formed. If the price then moves to or breaks through that P1, P3 entry line, that point becomes P5.
And the idea is?
ARPS suggests there's a high probability, once P5 forms by hitting that entry line, that the price will then continue towards the P1, P4 target line. He even includes an optional timing line, P2, P4, which, where it intersects the entry line, might suggest when the price could reach the target.
So potential entry at P5, potential exit near the target line.
That's the concept. The indicator plots the entry line in magenta, target line in gray. It has alerts for when the P4 setup appears, P4 alert, and when the P5 entry triggers, P5 alert. You can also control how far the lines extend, plot bars, and look back at past patterns, OCCR.
Seems quite specific. Needs careful study.
Definitely. It relies on precise pivot relationships. But it's a good example of translating observed geometric patterns into a potential trading strategy.
All right, moving on from specific patterns to defining the broader road the price is traveling on the channels.
Yes, exactly. ARP sees these as visualizing the highways for prices. They help define the trend and the likely limits of price swings within that trend.
First up are the fib channels.
Right, the TT-Fib channels A and B. These plot support and resistance lines around an 89-period moving average.
Why 89 Fibonacci number?
You got it. And the channel lines themselves are spaced out using other fib ratios. 8%, 13%, 21%, 39%, 55% above and below that moving average. ARP suggests running both A and B together.
And the key observation.
Prices often seem to reverse when they hit those outer boundaries. They tend to bounce back towards the other side. The scaling input lets you tweak the width, and you need a decent amount of data, like 200 bars, because of that 89-period average.
Okay, next is Andrews's pitchfork, named after Dr. Alan Andrews.
That's the one. Based on his median line theory, you need 3 key pivots to draw it. P1, the start of a significant swing, say an upswing. P2, the peak of that swing, and P3, the bottom of the following reaction, downswing.
How's it drawn?
A median line goes from P1 through the exact midpoint between P2 and P3. Then parallel lines, the tines of the pitchfork, are drawn, starting from P2 and P3.
And the theory is price respects these lines.
Yeah, the idea is price tends to gravitate towards that median line. If it reaches it, it might reverse. If it pulls away from the median line, it often heads towards the parallel tine on that side. Breakouts from the pitchfork can signal a bigger trend change.
Elliott wave connection here too.
ARPS mentions it. If P1, P2 is wave 1 and P2, P3 is wave 2, then wave 3 often terminates near one of the pitchfork lines. The T.T. Andrews pitchfork study plots this automatically using the latest zigzag pivots, controlled by TCH, GPC, CCHG. You can look back at past pitchforks, OCCR, or adjust for steep markets, ADJ just.
Then there's the linear regression channel. Sounds more statistical.
It is. The middle line isn't just connecting pivots. It's a best fit line calculated using the least squares method over a swing defined by the zigzag.
So it's like the statistical average path of that swing.
Pretty much. Then the channel boundaries are drawn parallel to that midline. How far away they are is up to the user. You can choose standard error, standard deviation, a percentage, high, lowest low, or RAF channel methods.
What does this channel tell us?
Quite a bit, actually. The slope gives you the immediate trend. The width gives you a sense of volatility. The length shows trend persistence. And the lines themselves act as dynamic support and resistance. A breakout, again, signals a potential trend change.
Lots of options there for calculating the width.
Yeah, STBD, PC to Chan, Hilo bars, RAF Chan. ARP stresses you should only have one of these set to true. Plus options for price source, zigzag settings, showing past channels, manual overrides, date ranges, extending lines. It's quite flexible.
Okay, last in the channel group, auto trend lines. These use Tom DeMark's idea.
Correct. DeMark drew trend lines differently from right to left, connecting successively lower high pivots for a downtrend line supply and successively higher low pivots for uptrend line demand.
Yeah.
The pivots used are based on that strength setting we talked about earlier.
And the indicator draws these automatically.
Yep. TT auto uptrend and TT auto downtrend. They plot the lines, mark the pivots with crosses, and extend the line until a new valid pivot requires an update. Big feature here is the breakout detector.
It flags when price crosses the trend line.
It does, highlighting the first bar to break and offering alerts. But crucially, it also applies DeMark's 3 conditions to check if the breakout is valid.
Ah, so not all breakouts are created equal.
Exactly. A valid breakout gets a green cross, suggesting higher reliability. An invalid one gets a red cross, maybe indicating a false move or head fake. Again, strength sets the pivots, OC curve looks back, length sets the search window, and freeze can lock a specific trend line. You can also turn off the breakout signals if you just want the lines. SHOB countdown.
Okay, that covers channels. Let's shift to defining specific price levels, support and resistance.
Right, those zones where buying or selling pressure tends to emerge. ARPS acknowledges they can be subjective, influenced by psychology, self-fulfilling prophecies, maybe.
But you still need to be aware of them for planning trades, right?
Yeah.
Risk-reward assessment.
Absolutely crucial. And he reminds us of that key principle. Old support also becomes new resistance once broken, and vice versa. Why? Because trap traders might try to get out at break-even.
And always keep an eye on previous daily, weekly, monthly highs and lows. Those are often significant.
Definitely. So his tools here start simple. TT Intraday HL midlines just plots the current day's high-low and midpoint on your intraday chart. immediate reference points.
Then weekly and monthly versions.
Yep. TT Weekly H, L, midlines does the same for the week. Can be calendar week or last 5 days via calendar input. TT Monthly H, midlines for the month, calendar or last 23 days. These plot on intraday or daily weekly charts.
What about floor pivots? That sounds old school.
It is. Comes from the floor traders. They'd use yesterday's high, low, and close to calculate expected turning points for today. The main one is the pivot point, PP, H plus L plus C3.
And then support and resistance levels are derived from that.
Correct. Formulas like R1, 2 ppl, S1 equals 2 pph, R2 will 2p plus HL, S2 equals ppHL. His TT floor pivots A plots S1, S2, and the PP, TP floor pivots B plots R1 and R2. Designed for intraday, need a few days of data.
And there are midpoints, too.
Yeah, the halfway points between those classic levels also became important. TT floor pivots mid-plots those. He also mentions TT hourly pivot lines, same idea, but calculated hourly based on the previous hour's HLC, plotted on a 5-min chart. Needs a multi-data setup usually.
Okay, what about projecting today's range?
2 tools for that. TT Daily Range Projection 1 uses Larry Williams' method. Projection 2 uses Thomas DeMark's method. Both use yesterday's HLC to project potential high-low limits for the current day on an intraday chart. Different formulas, different projections.
Then we get into Fibonacci, retracements, and extensions. Standard stuff, but important.
Very standard, very important. Retracement's price pulls back a certain percentage of the prior move, often 38%, 50%, 62%. These can act as support resistance.
And extensions project forward?
Right. Using the length of a previous swing to project where the current swing might end. Common levels are 138%, 162%, 262% of that previous move. ARPS connects these to the Fibonacci sequence, 0, 1, 1, 2, 3, 5, 8. And the golden mean, 0.618, 1.618.
Found everywhere in nature, math, and markets, maybe because people expect it.
That self-fulfilling prophecy idea again. He lists key ratios, 10.382, 0.510, 0.618, 1.00, 1.272, 1.618, and so on. The TT Autofib retracement indicator plots these automatically based on recent zigzag swings.
And TT Autofib extension does the same for extension levels.
Exactly. Plots potential targets based on previous swings and the selected fib ratios. Both update automatically as new swings form. He suggests using a slightly larger TTKC, GPC, TCHG for these than your main zigzag, maybe double, to catch the more significant swings.
Now, this next one sounds really interesting. TT price magnets, a revolutionary concept.
That's how ARPS describes it. It aims to project support and resistance zones based on analyzing previous swings. TT price magnets up projects resistance zones, down projects support zones.
How are they plotted?
As colored crosses that form upper and lower boundaries. So you get a zone, not just a line. The width of the zone depends on the characteristics of the prior swings used in the calculation.
And the claim is price is drawn to these zones.
Yeah, ARP states a high probability, over 75%. That price will gravitate towards a magnet zone and react there, find support in a down zone, resistance in an up zone.
Yeah. What if it breaks through?
Often leads to a stronger move, and the broken zone can then reverse its role. Old support becomes resistance, etc. They recalculate as new swings form, but old zones can still be relevant.
Only one up and one down set visible at a time.
That was a platform limitation back then, yeah. Key inputs are strength, again controlling swing sensitivity, and look back, how far back it searches. Finding the right values needs experimentation. He suggests maybe 1 to 5 for strength. Look back less than half your chart bars.
Running it multiple times with different strengths sounds like a good idea.
Definitely. You could layer zones of different significance. He also notes they create a stair-step effect in trends. And if a new up magnet forms higher than the previous down magnet in a downtrend, that can be a reversal signal, and vice versa.
Very cool concept. Okay, finally, the oscillators in the toolbox.
Right. ARPS selected 3 he felt were best for spotting swing turning points, claiming they have some look-ahead ability. Radar 1 sentiment, Radar 2 acceleration, and Radar 3 OBOS.
Radar 1 sentiment based on price and volume.
Correct. It's a histogram measuring buying, bull's green zone, versus selling, bear's red zone strength. Bar height shows intensity. Great for spotting divergence and confirming trend persistence.
That often leads price.
That's the claim. Acts as an early warning. Divergence is key, like a shallower valley on the indicator, while price makes a lower low, bullish divergence, or a lower peak while price makes a high, bearish. He also notes double peak valley formations often precede big reversals. Works on all time frames.
Radar 2 acceleration focuses on the rate of change.
It's exactly. An early warning for direction shifts. It has a fast red line and a slow green line. Fast line crossing the slow line is the initial signal. Slow line crossing the 50 level confirms the direction of acceleration. Above 50, up below 50, down slowing.
What's the slingshot effect?
If the slow line had moved far away from 50 before crossing back, the subsequent move tends to be stronger. ARPS claimed it calls turns before MACD, stochastics, RSI. Again, divergence is powerful here,
Yeah.
especially a second divergence.
Any drawbacks?
It can be sensitive, generating signals on small, choppy moves.
Yeah.
So focusing on divergences or using Radar 1 as a filter is recommended. Inputs control to speed, fast-lin, slow-lin, or apply smoothing, smooth.
And Radar 3, OBOs, overbought, oversold.
Yep, a proprietary triple smooth histogram. Blue bars above 0, uptrend. Magenta above 0, pullback in uptrend. Magenta below 0, downtrend. Blue below 0, pullback in downtrend. Pretty clear visual. Robust across time frames, single input sensitive, controls the look-back horizon, higher, longer term.
Okay, then the divergence detectors, normal and type 2.
Right, we already mentioned normal divergence. Oscillator fails to confirm new price extreme. Type 2 is rarer, but may be stronger. Oscillator makes a more extreme reading, while price makes a less extreme one. Example, deeper oscillator valley, but higher price low. Both signal potential reversals.
And his indicators automate finding these.
Yes, the TT divergence, normal and TT divergence, type 2 plot filler dots on the price chart when they detect these patterns using an oscillator you specify. Can be filtered by OBOS levels. Normal uses green-red dots, type 2 uses blue-magenta. Running both helps spot key turns. Strength input, again, controls oscillator swing significance.
Almost there. Pro-mom bars.
TT Pro-Mom bars, up-down paint bars, simple concept. Paints bar is blue for uptrend momentum, red for downtrend momentum, consecutive colors, more reliable trend, alternating sideways chop, length input tunes, sensitivity.
And finally, the stops. TT Pro Stop.
A volatility-based adaptive trailing stop. Aims to avoid getting stopped out by normal noise.
Yeah.
Stop P as an S input adjusts how tight or loose it is, lower, tighter. Comes as an indicator, plus line, or a system. Issues exit orders.
And there's a stop and reverse version?
Yep. TT Pro Stop and Reverse Adaptive Trailing Stop System. Always in the market. When the stop is hit, it exits the current position and enters a new one in the opposite direction.
Wow, okay, that's a comprehensive toolkit.
Yeah.
So wrapping this up, we've really covered a lot from ARP's work.
We really have. From the why, the psychology and geometry, to the how, visually defining swings with tools like the zigzag. Then specific pattern recognizers like the 3-wave and Fox-wave.
Plus all the channel tools, fib, pitchfork, regression, auto trend lines, and a whole suite for support and resistance pivots, projections, fib levels, those intriguing price magnets.
And finally, the oscillators like the Radar series, divergence tools, and the practical stop-loss mechanisms. It's a very complete system he put together.
Understanding these concepts, these tools, it really feels like it could give you a significant edge in trying to navigate those market swings. Maybe get closer to that ideal of buying low, selling high with risk managed.
That's certainly the goal ARP's laid out. It provides a structured way to analyze and interact with market movement based on observed patterns and dynamics.
So here's a final thought for you, the listener, to chew on. How might this constant dance between the psychology we talked about, the geometric shapes that form on the chart, and the signals from all these indicators, how might they actually feed back into each other? Do they create loops that, in turn, shape the market's very rhythm, its breathing?
That's a deep question.
Maybe pick just one or two tools from today that caught your interest. Try applying them to your own charts. See how they feel, how they perform in the markets you follow. It's all part of developing that intuitive yet informed sense of the market's ebb and flow.